7 to 8% yields on treasuries via Buck ETF. What's the catch? Hello, members, super savers, and bond course fans. I hope you're healthy and well. So one of our super saver members, Walter K., had asked in last month's live member Q&A about Buck, the ticker symbol for Simplify Asset Management's Treasury Option Income ETF. The main selling point for Buck is simple. Buck promises to combine the safety of treasuries with a bit of extra income on top using derivatives. And indeed, the extra yield that Buck offers with its treasury portfolio is turning a few heads in our Diamond NestEgg community. So much so that when we posted this recent video on whether China was dumping treasuries and if treasuries would hit 6% or higher, link below in the first pinned comment for your convenience. One of you wrote, "Just buy Buck and forget about it," yielding way more than 6%. So, with that in mind, here are the 3 topics that we'll be covering in today's video. 1. What is Buck and what makes Buck so attractive? 2. What is the risk to an investor if Buck only holds treasuries in its portfolio? After all, treasuries are considered to be the safest, most liquid investment in the world. 3. What else do you need to consider? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. What is Buck and what makes Buck so attractive? Buck is issued and managed by Simplify Asset Management, which was founded by Paul Kima and David Burns, 2 industry veterans, in 2020 in Las Vegas, Nevada, with a mission to make institutional-grade alternative strategies available to all investors through the low-cost and transparent ETF vehicle. They currently show 36 ETFs on their website and a total of $7 billion in assets under management. Buck is one of these ETFs, and they describe the product as follows. The Simplified Treasury Option Income ETF, Buck, seeks to provide monthly income by investing at least 80% of its net assets in U.S. Treasury securities while adding additional value through an options income strategy. The Treasury component is actively managed to seek the highest total returns while maintaining a duration of 1 year or less. The risk-managed options writing strategy is designed to provide additional income as well as add to the fund's total returns. So in essence, Buck buys a portfolio of treasuries with a short duration of 1 year or less and then writes options on top for extra income, somewhat similar in its approach to how enhanced revenue equity funds work, as we've discussed before in these related member videos on Boomer Candy ETFs and funds, link below for your convenience. And this extra income does indeed look nice at first glance. According to Morningstar, at the time of this taping, Buck had a 12-month yield of 7.79%. And a month ago, that number was even higher at 8.23%. As a point of reference, this is where the treasuries with maturities of 1 year or less are trading at the time of this taping. So the extra yield premium that Buck offers certainly does look attractive. But as our Diamond NestEgg regulars know, one of the fundamental pillars of personal finance is higher risk, higher return, which brings us nicely to the next section of today's video. What is the risk to an investor if Buck only holds treasuries in its portfolio? As many of you hear me say often, treasuries are generally considered the safest, most liquid investment in the world. And given that Buck holds mostly treasuries in its portfolio, it's safe in that sense, meaning there's limited credit risk or default risk. As so frequently in life, though, what looks simple at first glance may become much more complicated when you dive into the details. So complicated, in fact, that we are devoting both our April and May member videos to Buck, including a much more comprehensive explanation of the option strategies they use to generate their additional returns. So Diamond NestEgg members, consider today's Buck video to be just the appetizer as part of a 3-course meal. For today's appetizer video, suffice it to say that the risk with Buck really lies in their options writing strategy that is designed to provide additional income as well as add to the fund's total returns. In a nutshell, Buck writes or sells call and put options on the underlying treasuries that it holds in its portfolio, meaning it offers another market participant the right to buy or sell some treasuries at a pre-agreed price at some point in the future. The pre-agreed price is known in the options world as the strike price. And by charging a fee for writing or selling these call and put options, Buck generates the additional income needed to give its investors the additional yield that you see here over just owning treasuries outright. According to their website, Buck will typically select strikes with about 90 to 95% win probability, which is financial speak for saying that the managers of Buck expect that 90 to 95% of the options they write will expire unexercised, that the strike price will never be reached, in which case Buck wins because they can keep the additional income from selling those options as well as the underlying treasuries in their portfolio. So basically, as a Buck investor, the risk isn't really credit risk or default risk when owning Buck. The risk is whether the Buck management team has the skill, judgment, and or luck to select the right mixture of call and put options to sell with winning strike prices. In other words, what happens if instead of a 90 to 95% win probability, Buck's management hits a bad patch and they start losing more often? And what happens when the Treasury market experiences volatility like it did earlier this month? How does that impact Buck and its investors? Which brings us nicely to the next section of today's video. What else do you need to consider? Here are 3 additional factors to note when looking at Buck. First, the yield may be important, but so is the total return. In fact, this is something every investor should look at when it comes to investing. Total return basically includes the cash payouts as well as any capital gains or losses, essentially meaning changes in Buck's share price. Yes, Buck has a high distribution yield at the moment, as we've already shown you, but Buck's year-to-date performance doesn't look quite as stellar. Its total return on investment based on price is minus 1.19% so far this year. Compare this to the Bloomberg government corporate 1-year duration total return US dollar index, which has a total return on investment based on price of plus 1.89% so far this year. When looking at NAV or net asset value, Buck's total return on investment is minus 1.25% so far this year, compared to the category return of plus 1.34% for other ultra-short bond funds. As I talked about in the previous section, Buck's overall performance is dependent on whether the Buck management team has the skill, judgment, and or luck to select the right mixture of call and put options to sell with winning strike prices, which can be particularly complex when bond markets are volatile, as they have been in recent weeks. And these negative total returns on investment that we see here year to date may be a reflection of the current market uncertainty as well as other factors. But essentially, what these numbers show is that yes, as a Buck investor, you may have gotten some nice monthly payouts this year from Buck's portfolio of Treasury holdings, but on a total return basis, you would still have lost money. Moving on now to the second factor. Buck's 12-month yield is not the same as the current yield on Treasuries. I know that comparing Buck's 12-month yield to the current yield on Treasuries is what many of you do when trying to decide what's better. But please do keep in mind that this 12-month yield here and these Treasury yields here cannot be compared one-to-one. They're more like apples and oranges. As I've already shown you, this 12-month yield can and usually does change from 1 month to the next. This 12-month yield on Morningstar is basically a certain way of measuring the cash payouts you would have gotten from your investment in Buck over the past 12 months. It's backward looking. If you were to buy Buck now, this 12-month yield is not necessarily the yield that you will get going forward for the next 12 months from your investment in Buck. Compare this to the yield here on a 1-year Treasury, which is basically forward looking. If you were to buy this 1-year Treasury today, this is the yield that you will get over the next 12 months from your investment, assuming you hold it to maturity. And to complicate things further, these 12-month yields here are only one way of measuring Buck's performance. There are additional methods as well, such as the 30-day SEC yield. But as I mentioned earlier, we'll be diving deeper into the other performance measures in our upcoming member videos on Buck. And we'll also discuss why costs are not really something you need to be careful of when comparing these performance indicators. Well, because they're mostly already included in the calculation. And the third factor to consider, Buck is a relatively small and new fund. It has $324 million in total assets, according to Morningstar, and was only established in October 2022, so less than 3 years ago. This also means that we don't really have a longer-term track record yet for comparison purposes. As you can see, while Buck may currently offer a higher yield on its Treasury portfolio, without exposing an investor to a higher level of credit risk, there are still other risks to consider, and it's not as simple as what this Diamond NestEgg community member said at the beginning of the video. Just buy Buck and forget about it, yielding way more than 6%. So for those of you who've been asking for an even deeper dive into Buck, be sure to check out our Member Zone. Our next member videos on Buck will cover the following topics: how to assess Buck's performance as an investor. For example, what's the difference between the 12-month yield, the 30-day SEC yield, and the total return numbers? How Buck uses call, put, and straddle option strategies to generate additional income for its investors, as well as what are some alternatives to Buck that you may want to consider if you're looking for a bit of a higher yield in your overall portfolio. All right, members, super savers, and bond course fans, I hope you enjoyed this overview of Buck and learned something new today. And as always, if you want to learn more about treasuries, bond investing, and building a bond portfolio while rates are at good levels, then check out this video here on our bond courses. I've also linked all the details on our bond courses and our YouTube Super Saver membership below this video for your convenience. See you again very soon with more brand new wealth building content for your financial journey.